January 2nd, 2024. The open of the day was priced at 47.83 and a half. And that's important because the open of today is the first day of the day, week, month, and year. So, the first bar of the day, week, month, and year. And especially with the year, it's going to be a support slash resistance area for the majority of the year because the open of the year is always important. So, we might end up oscillating around it at some point in time during the year. I thought the most important price, though, coming into the day was going to be yesterday's low. Whenever you get a gap down, you can see we tested yesterday's low. That's what we were doing on 39. Whenever you get a gap down, the first target is always the prior day's low. And obviously, the second target would be, the close or the moving average. But usually it's the prior day's low. And bar one, bull bar, but a tail on the top. So not a good buy. Some bulls were buying, front running it, hoping that we were going to get a strong close on its high. And if bar one had closed on its high, it would have been an incredible buy, betting that this big gap down was just a bear trap. But instead, we get bad follow through. When you get a disappointing close like this, it's a reminder that it's probably a trading range open. And then you get a big bear bar closing on its low. Do you sell below two? I don't think it's that great of a sell. I think it's maybe a swing, but it's a really big bar. The risk is really large, and you're probably selling at the bottom of a developing trading range, so it's really not all that good. More follow through for the bears on bar three, but a big tail on the top, small tail on the bottom too. And, it's a much smaller bar, showing that the market overall just lacks momentum right now. Big bear bar on four, but a tail on the top, a couple tails on three and four. So it might be in the channel phase here. And it's more likely that we're going to end up in a trading range. Additionally, you got to think that the bulls who bought below one, or bought the low of one, have not been let out. Excuse me. Have not been let out at break even yet, so that might have to happen at some point. Bar five, doji bar, and bar five is a really important bar. If you were selling, three or four, well, if you sold three, first off, four was a surprisingly good entry bar. So a lot of times when traders get that, they're going to scalp out instead of adding on when it could be a trading range, and that's what's causing bar five. Now, traders who sold here on the close of five, this is a lower probability situation. So if you're selling down here, you want to see another big bear bar immediately. You want to see a bar that looks like two. You want to see big follow through for the bears and a collapse. And when you get a doji bar, that kind of reaffirms to traders that this is probably a trading range. And what they start doing is buying back shorts at the market. So they see five close the doji bar. They realize it's not what they thought it was. They buy back shorts at the market, and that causes the rally up on six. Six is one of those situations where the bar gets too big. If you're a bear and you have to get out during this, you can't just sit through the whole thing, because usually if you're wrong in a spot like this and it's trading range and starts to go against you, it can go pretty far against you, obviously, pretty quickly. And then you end up getting squeezed out at the top and you just took a big loss. So I don't really like buying above six either. The risk is too big. You also are following 2, 3, and 4, which are huge bear bars. Your 2 to 1 is all the way up here, so it's pretty unlikely we're going to get there before we get below 6. And 2, 3, and 4 are huge bear bars. So really, I think that the reversal up, while a good bull bar on 6, is probably going to be limited because 6 does not undo 2, 3, and 4. If you're buying above 6, you got to be expecting something disappointing, which is what you get on bar 7. Disappointing follow through. Tried to get back to the close of 1, wasn't quite able to. 8, buyers below 7 for a scalp, but I don't think, they bought around the 50% pullback of move around here. So that's why there were buyers there on 8, but I don't really think it's all that good to be doing anything here. Bulls are hoping that this is a new bull trend, this is a pullback, and bears are hoping that this was the pullback and that we're going to get a couple more legs down. Note that 2, 3, and 4 were strong enough to probably get a second leg, and I don't think we've gotten it yet, so we might have to get back down to the close of 4 to let those traders out around break even. You could argue they had a chance to get out during 6 around break even, but that's kind of, a lot of traders are still going to be trapped. 9, a bear bar, but a big tail on the top and tail on the bottom. It's an inside bar, and you could see the close of 9. So if you bought the close of 7, disappointed 8, trying to get out around break even during 9, but those traders weren't able to. More follow through for the bears on 10. So now you have 3 straight bear bars. So even if we start to get a reversal up, the upside will probably be limited. And that's where you get bad follow through, big tail on the top of 11. Probably going to get a second leg down. This was strong enough for another leg sideways down. And that's what's happening on 12 and 13. It's a second leg down for the bears. So you can look at this as 1 pullback, 2, and 2 subdivides or you could look at it as, a wedge of some kind. Um, Regardless, what you need to realize is you shouldn't be selling down here. You have a tail on 12 and a tail on 13. It's too likely it could be a second leg trap. And the follow through for the bears isn't all that good. And if you're selling down here, you're selling right on support, the 4 low. So you can see on 14, when we traded down here, we bounced. Why? Because traders who sold this close are really disappointed in how this went. Think about it. If you sold down here, you felt really bad when you saw this. And so you're trying to get out of break even. And that's what happened on 14. Those traders got out around break even. Bull bar on 15, but not that good. This is probably strong enough that we're going to go more sideways rather than up. And doji bar on 14, so we might have to test the signal bar high since there were some traders who would have sold above 14. 16, test the low of 11. 11 was a reasonable bar to buy below. It wasn't a great buy below, but it was reasonable to buy below 11. And that's why when you get back to that 11 low, you end up finding sellers, and that's what causes 16. 17, test the close of 15, essentially. And you can see we're in a tight trading range here. 18, more tight trading range behavior. Bulls are hoping it's bull trend and a pullback in their bull trend. Bears are hoping to keep their channel intact, their bear channel. But you can see 19, we get a strong breakout to the upside, so probably not going to work. Just expecting more sideways price action here, really. 20, more follow through for the bulls. It's probably okay to buy above 20. I would think it's follow through for 19, and it's a breakout above the high of the tight trading range. Additionally, 20 trades back to the 18 high, and traders bought the breakout point. And a lot of the bears are still trapped. So probably okay to be long, but then you get disappointing follow through on 21, and that's really not what you want. I would probably put a stop, a point below 21. What's interesting is I was thinking about that real time. I was thinking, I wasn't long, but I thought if I was long, I'd probably have a stop a point below 21. And then when we got 22, I'd probably have a stop a point below 22. And it only went 3 ticks below 22. It did not. So that stop would have been fine. 24, a bull bar. So 23, bad follow through for the bulls. We are in a kind of tight bull channel though. So when you get a good bull bar on 24, what are you thinking now? Well, you're thinking we're probably going to get at least a little bit of follow through, and you're hoping bulls can get a strong bull close all the way above the moving average. Now, usually I would, not advocate to be buying what looks like probably a third push up in a trading range, 1, pullback 2, pullback 3. So usually I wouldn't buy a third push at the top of a trading range, but I thought this was a special scenario because the bull channel was pretty tight. And when the channel is tight, a lot of times you can end up getting a rally. So you're essentially hoping for a breakout above the wedge and a measured move up to somewhere up here, which is about where we got. Additionally, this measured move is also right where yesterday's low is, so I thought that was really important, and that it could become a pretty obvious magnet if we were to reach it or start getting up to that area. Follow through for the bulls on 25, but now you're at the top of the bear channel or the bull channel, so you have to expect something relatively disappointing. A lot of times swings will try to trap traders out right before they go. I think that's what 26 is. It's a tight bull channel, but it's 3 pushes up, so it's kind of hard to hold through 26. It could be a double top bear flag with 7. So it's difficult to hold through 26, I think. One thing you could do is get out below 26 and then put a buy stop above 26. So that essentially, if it does exactly what it did and it traps you out and traps bears in, then right where their stops are, where they're getting stopped out, you can get stopped back in, and that'll add fuel to the fire, and you might start to rally. That's exactly what happens on 28. If you bought above 27, a lot of traders see 28 and they just take their 5-point scalp. I think they were able to make about 5 points. So they weren't able to make 5 points until bar or 2 after. But a lot of traders would just take the scalp when they get 28 since their true risk is 0. And that's what's causing the pullback on 29. It's also notable that 29 dipped below the 1 high. So any bear who sold the 1 high was able to scale in maybe a point or 2 higher, get out around break even. 30, more follow through for the bulls. We're entering probably a bull channel. We can pretty easily test the bottom of the channel, which is the 29 low. 31, a doji bar, really not good follow through for anyone. Disappointment on 32 because you're not going to sell below 31. The bull channel is too tight. 33, sellers above 32, which is to be expected. 34, a bear bar trades below the channel, the 29 low, so potentially trapping out some bulls. 35 tests back into the trading range, and 36 inside pattern, so breakout mode essentially. 37, a bull bar closing near its high. It's an okay swing buy. You probably, if you're always in, you're probably expecting to get back to this low, or that's your goal. But this is a trading range from 30, or I guess 29 to 37. So we're in a trading range, so it's kind of difficult to buy because you're buying high in the trading range. It is, you are still. You could argue that that's a channel line break. You could also argue that the channel line is maybe a bit wider, something like this. But I thought that this channel here was a bit more valid. So I was concerned this might have been a channel line break or a trend line break. But anyways, 37 is a reasonable buy. And you get big follow through on 38, and you would think 38 is a reasonable buy too. And then you get a doji bar on 39, and then suddenly a collapse on 40. So what was happening? Well, if you think about it, a lot of times the most climactic move comes at the end of a trend that's 20 plus bars. And we're about 20 bars into this trend on bar 37 and 38. And when you get these bars, they're the best looking bull bars that we've had so far. And you might look at this and think that these were the best looking bull bars, but this, 28 is a climactic bar. It's too big. So it doesn't look as good of a buy the close bar. And this bar didn't close on its high. So 37 and 38, I think, are the best looking bull bars we've had in this whole trend so far. When you're getting the best looking bull bars late in a trend, it's oftentimes going to be climactic. And especially considering we're right at the measured move target and we're right at yesterday's low. So we're at a lot of resistance getting a climactic move. So what a lot of traders will do is maybe they'll buy above 37 and they'll just scalp out at the low. And then if you get an impressive bar on 39, let's say 39 closes on its high, they'll re-add to their position. Other traders will buy, the 37 high, the 38 high. And then when they get a disappointing close on 39, they say, well, that's not what I wanted. I was hoping for a really good bull bar. But it clearly seems like traders are taking profits at yesterday's low. And those traders will exit at the market, and that causes the big bear bar on 40. Follow through 41, 42. Okay to sell the close of 42, I think. It's a big bear surprise, so it's probably enough for a second leg down. But this channel is relatively tight, so we're probably going to need to go a bit sideways first. 43, more follow through for the bears. I actually need to put the daily chart in something, so I just pulled this up. Well, my point being, first off, that I thought this was consecutive sell climaxes. So we started to get this reversal down, like I said, 43, 44, more follow through. 45, bad follow through, but overall expecting a lower high. More follow through 46, 47, but big tails on the top, so probably not going that far. And then you get a reversal down 48. It's a low one short, and you can sell it, but if you sell it, you need to stop above 39. You're basically betting on a lower high, and then that we're going to at least test back down here, and then you can see how that looks and debate what you want to do. But if you sell below 48, I don't think you can really get out above 49. I think you just need to stay short with a stop up here. 50, bad follow through for the bulls who bought above 49, which is expected. 51, a bear bar, but not a very strong close, and then outside down 52. So you have an outside pattern, 51, 52. When you get an OO, it's a breakout mode pattern. It's going to be a sell. And consecutive climaxes. I have a couple examples. We had 1 pullback, 2 pullback, 3 consecutive climaxes and a reversal up today. And one other example, 1, 2, 3. You could argue that, and then you could argue this is consecutive climaxes on the way down. So anyways, follow through for the bears on 53. It's back to sell the close. It's reasonable to sell the close. You're selling higher in what's probably a developing bear channel. So you have to assume the channel line somewhere down here, which it was. More follow through 54, 55, all reasonable sell the close, probably enough for a second leg. And something you have to think about, though, is that we've been in a trading range all day, right? So it's probably a trading range day. However, you're getting, unusually good closes. A lot of times when you're in a trading range day, there's going to be a lot of tails and such, and you're going to have trouble, you're going to have trouble scalping out with 5 points. But you can see here, you're getting really strong bear closes, really good closes on 50, 53, 55, and 54 is not all that bad either. There's just not that much overlap. So 56, big tail on the bottom, probably going to pull back. You can see 57, we traded above 56, so that is a pullback. Low one short 58, but not all that great. You're probably selling low in what's developing trading range. 59, follow through for the bears, but not all that good. Bears are hoping to get a big giant bear bar closing somewhere down here, and they don't get it on 59, so a lot of them exit during 60. If you exit above 60, it's a high two, second reversal towards the bottom of a trading range. So I think it's okay to get out above 60, but you can sell again below 61 or 62. Those are both credible. Bad follow through 63, but we end up getting a surprise outside down bar 64, and then more follow through 65, 66, 67. And then disappointment 68, inside bar 69, and a surprise up on 70. And I would not trade this personally. I would let it go. It's a trading range day, right? So you can get dramatic moves in trading ranges. And you can see we've got to move, essentially all the way back to the top of the channel. You could argue this is the spike, the pullback in the channel. So we got to move all the way back to the top of the channel. I thought the open of the day was initially the magnet, but we ended up racing right through it. But I think that the open of the day on trading range days is a really important magnet. So even though we raced right through it during the Globex session or tomorrow morning, I assume we're going to test back down to this price and see what's there, because it's a pretty important magnet. It's unusual to just go straight through a magnet and not test it. For stop orders on the day, I think probably 20 is okay, but it's not great. 24, 25, 27, 37 you can take, but you need to be really, really hyper aware of this target if you're going to take something like 37 and probably get out pretty quickly. You should be good enough at managing this trade to exit with some sort of profit. Let's put it this way. If you're going to take 37 and this happens, you should be exiting with some sort of profit, I think, because the management's difficult. But if you're buying above 37, you're buying knowing the management is difficult. So you could sell 42. You could probably sell 48 with a wide stop. 52. You could sell 52. You could sell 53. You could have sold 60, 62. Really take any of these bear bars closing near their lows. You could have sold. And that was that. Where do we go from here? On the daily chart, we got a small bull close. You can look at it as, probably going to get one, pull back two. I think we might end up having to get to this close since there are a lot of bears who sold it and they're now trapped into a losing trade. But I think they'll end up getting out around break even. So a couple legs sideways to down to the moving average. I'm expecting, a 30, 40 bar correction and then potentially a second leg up. The weekly chart, we've had straight bull bars ever since, October, really. So all bull bars. So pretty much expecting a bear close at any time now, especially considering how much the momentum is drying up. It'll be interesting to see if we get here and allow limit order bears to make money, which, I think they probably will eventually end up making money here since this is probably a leg in a trading range. This whole thing is probably a leg in a trading range. And you could argue it's one, pullback two, pullback three. So some sort of consecutive buy climaxes and blow off the top finish. Yeah, that's it.